what we'd like to do is just go ahead and jump into it. And thank you again, Julie, for your time this afternoon.
Thanks for having me. I appreciate it. And I look forward to talking with everyone. And
Great,
just parenthetically, Ernie chaired the first, the committee of the Angel Oregon, first angel investment I ever made. I think it was back in 2012.
Something
I
like
can't
that.
remember, a while ago. So we go way back. So I'm happy to talk with you, and let's get launched.
All right, Ernie.
All right. Well, Julie, you have a list of these questions. How would you like me to do it? Would you like me to kind of just read them up to you every so often?
Yeah, sure. Why don't you, do you want to just pick out the ones I mean, we can do it in however you receive them, or if there are some that are sort of batched and similar, happy to field anything.
Well, let's start with the fundraising process. Maybe that's an easy one. And and the hardest one for a lot of companies is, when do you start raising money and when do you start talking to people?
Yeah, that's a great question. So just so you know, I mean, I feel the pain of fundraising, because raising a fund is also very difficult work. Over the last 8 years, I've raised about $20 million in Oregon, and it's hundreds of conversations. So the question really is, I think, upstream from that, which is, do you get outside investment money or not? And not every company is an investable company. So you could have a great company, but if it's not designed to scale to the point that investors would be interested because of the potential returns, then there are other considerations. It's also true that whenever you take an investor on, you're taking a business partner on. So there's some things to be really careful about. And so we have a lot of companies come to us every year that we think are great companies, but aren't necessarily venture type seed stage companies that we would invest in, because we can't get a 3x or more return from that investment. So sometimes it's just about math. Sometimes it's about the thesis of the fund. So some funds focus on, I talked to a fund manager today that focused on health and wellness. We tend to do 25% consumer brands and 75% tech. We don't do food and bev, and we don't do companies that have a hardware component. So when, now or never, and early and often. So you have to be constantly if you start fundraising, in a way, you have to think about constantly fundraising and constantly having that network. And I think it's important to think about the fundraising process as a sales process, right? So the kind of communication that you do, the way you reach out, the trust that you build, is all, it's exactly a sales process to get an investor to commit. I would also say in this process that it's important to do as much due diligence on the investors as you do on them, because once you take a business partner on in terms of investment, it's actually harder to get out of than a marriage.
That is true. It's like you've asked them to join you, and then now they're in, and it's not easy to get rid of them if it doesn't work out well.
And I'm sure you've seen that too.
Yeah, definitely. So I guess if you're from the entrepreneur's perspective, then how do you, what kinds of things should the entrepreneur be learning about the funds themselves to help make that decision? In other words, is this the right investor for me to invite into my company?
Yeah, it's a great question, and can be kind of difficult in that a lot of investment funds, it's not completely clear who you're supposed to talk to or what you're supposed to do. So I go back again upstream, and that is doing everything you can to learn how to effectively network. And by that, I mean really build relationships that make sense to you. But you'll start to see there are really kind of 6 to 9 different types of investors. So there's individual angel investors. There's angel groups, which they'll look at a potential investment, and then if the individual angel likes it, they'll write a check. There's angel funds, there are seed stage funds, there are Series A stage funds. So each lane of that timeline, there are different sources of external funding. But I think starting with understanding, like we get questions all the time about what our thesis is and how we do our work, and it's all on our website. It's right there. So if somebody doesn't fit inside those parameters, they shouldn't be wasting their time sending us information. Sometimes we get information or we'll have a conversation and we're able to refer to other people. So it really just depends on how ambitious you are about, contacting fund managers.
So Julie, are there unique challenges in the Oregon market or in the Northwest market for raising capital? I mean, would you go about sort of building these relationships with funds or with people in the investment community differently?
I think that in Oregon, it's a pretty friendly environment. We have people like Laura who are out in the community. We have the Bend Venture Conference. We have Oregon AF. So Oregon Entrepreneurs Network really can facilitate those connections. And also, I would say, with funds like Elevate, Portland Seed Fund, Cascade Seed Fund, Oregon Venture Fund, everybody has people out in the field that are looking to meet entrepreneurs. And so it's not like you need to necessarily know the secret handshake like you might in other major metros, because we're still a pretty small state. That said, because we're a small state, there's not tons of capital around, right? And especially in today's environment with the meta themes as far as the economy, it makes it tougher. But what that also means is that, we're looking for really, really good opportunities. And so I would think most founders, if you have something legitimate to talk about, you can get to Oregon fund managers pretty successfully if you put yourself out there.
Yeah, that makes sense. Small community, but approachable. Yes.
Yeah, definitely.
So I guess once these entrepreneurs have reached out to you and they're doing networking, how do you decide on which ones that you want to fund? And are there certain pieces of information that are most helpful for the entrepreneurs to be conveying to you when they get to meet you?
Yeah, we like to see an initial pitch deck, and something that is, took a while to get demystified in my own head when I was doing this, when I was raising money as an entrepreneur, is if you take money, then the idea is that you will return it. And a lot of times the math seems very complicated. So basically, companies that have momentum towards their first $1 million in revenue are attractive to early stage investors. Where the companies, and it turns out that can be really hard to do to get to $1 million in revenue. The next kind of break is 3 to 5 million, and then after that 10 million. So you think about if you raise $1 million and an investor has a thesis that requires them to get 3 to 5 to 10x their money back, then if you raise $1 million and they want 10x back, it's $10 million that they want to have returned to them. That math can get really complicated quickly. So early understanding what is called the cap table, which is how the company is capitalized, is very important in terms of maintaining the percentage of ownership that you want and need to, and making sure that the terms aren't punitive. So a lot of times when I do these conversations, I'll say things like that, but unless I tell a story, it doesn't really make sense. So what happens with a lot of early stage founders is that it's the most expensive money that you will ever raise is really early, because that's when the investor's taking on the highest risk. So sometimes entrepreneurs will take terms on a deal that make it really hard for the next set of investors to come in on, or they'll dilute themselves, their ownership so substantially that by the time they get to be successful, they don't own enough of the company to make any money. So we talked to these guys one day who had a huge multi-million-dollar exit, and they each made about $100,000 because they were so diluted and they were into it for so many years, there just wasn't any value there for them. We talked to a company that we were very interested in investing in, early stage company. And this will happen sometimes with women-owned and non-traditional entrepreneurs where the terms by the investors, like everybody in the community rallies around somebody, but there's layers and layers and layers of notes and debt and things like that. And that makes it really hard for the next set of investors to come in. So really making sure, and I want to issue a disclaimer in that I'm not providing any legal, tax, or accounting or investing advice today. But I would say having a good attorney in place early on that's seen a lot of different deals is really important. And sometimes it seems like a needless expense, but this is for many, many people, they have a good idea for a business, but they've not necessarily raised money. And so the technicalities of it up front can really get in your way downstream.
That probably leads us to, and maybe you're starting to touch on this, is, again, what are some of the common mistakes that entrepreneurs make when they're, you've already kind of touched on the cap table and some of these terms, but again, let's dig into that some more.
Sure. I mean, I think the first mistake is starting the business in the first place. And I say this as a person who started many businesses, let's just be clear. But, I mean, it is not an easy path. It is, I always say it's like, you wake up every day with a smile on your face and a little terror in your heart, because there's just so many things that can go wrong. And what happens is most people think because they have a great idea that they have a business. And it turns out that really running an effective business is an altogether different situation. So the question was about common mistakes. Was that what it was?
Yes.
Yeah. So sometimes people say, can I meet with you? I really want to figure out if I should start a business. I'm like, no. And yet here I am. And secondly, I think most startups are underfunded from the beginning. So a lot of people don't necessarily have generational wealth. They don't necessarily have a house that they can get a mortgage on, or, like all these weird things that people do. And so being really sober about the financial, the hard kind of financial aspect of it is an important feature. Oftentimes, and I started 3 businesses actually in economic downturns, so clearly I must be a fan of it, but it was sort of by accident. A lot of times with like the Great Resignation and COVID and the way the environment is now, people are sort of like, well, I just want to do what I want to do and I'm going to try it. And I love that. I love that. I've done that several times, and for me, it's great. I wouldn't recommend it for everybody because of the level of risk and stress that's involved. Having another mistake that people make early is, again, not making a small investment in having good professional services providers. So making sure that your finances and your books are set up well, that you have the right agreements in place. I can't tell you the number of early stage companies that have gotten in trouble because they don't have contractor agreements with somebody. And then, they have their friend Bob work for them and pay them some money. And then the person comes back and says, oh, you've been successful. I'm owed 20% of that money because I provided you with this help, right? So the other mistake that's a really interesting one, and I don't really know why this happens, but in the entrepreneurial world, there's a lot of helpers, right? So there are people that have had careers and they want to help, and then it turns out that they want a huge percentage of ownership of the company, or they want financial control because they will always, this group of people will always overestimate their value to an entrepreneur. And this is me as an entrepreneur speaking. And so it's really important to make sure that if you have an advisor, that it actually matches with your gut, and that you vet those advisors, because again, I have heard some stories about, people getting advice from people who've been in big companies their whole careers, and it really is different having a small business or a startup. And by the same token, there are a lot of people out in the community that are very helpful. I mean, Jim McCrate is a great example of this, where, Jim, you've been at this for a number of years, and it's like very fair, very, very honest, very measured kind of input. And that's really what's needed when you're having an entrepreneurial attack that says you need to start a business. So those are some of the things, and I think you can really get ahead of that by being measured and thoughtful about what's going on. And a great way to learn is to be around other entrepreneurs. So that's one of the reasons I like OEN, and we don't call it OTBC anymore. What do we call it?
Oregon Startup Center.
Oregon Startup Center. Yeah, there we go. Oregon Startup Center, and a lot of the stuff that Ty does, and all these different forums are a way to get a little bit of exposure without having, committed your whole, family's fortune to your startup.
All right. Well, let's shift gears a little bit. So maybe if some of these mistakes have been made and you've had an entrepreneur come to you, why is it that so many entrepreneurs get many no's? I mean, why is it a process that feels like it's a lot of no's first?
Yeah, that's also a great question. I can't remember who told me this, but it was something like Jeff Bezos got 450 no's before he got a yes, or some crazy number like that. So here in Oregon, what I have noticed, and we noticed this as a fund, is there are way, 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 way more people coming to us with ideas than we actually have funds to invest. That's one piece of it. That's kind of a common narrative, though, that a lot of entrepreneurs will blame and say, oh, there's just not that much money in Oregon. Some of it has to do, that is definitely a factor, but some of it has to do with making sure that you really understand and are able to articulate the value proposition of your enterprise. So I'm a person that likes to do well and do good, and so I love investing in Oregon entrepreneurs and Pacific Northwest entrepreneurs. But in the end, the fund managers are judged not by how nice we are, but by our returns, right? And so sometimes when it comes right down to it, it may be a great business, maybe a great person. You may have like tons of, like we just said no to an investment that I really, really, really wanted to do sort of personally, but I could not get my head around the value proposition and how they might, have a breakout success. And so I had to say no. And I think it's important. Sometimes I feel like I'm telling someone's baby that it's ugly, that their baby is ugly, and it's not really that. It's just that there are all these dimensions to our decisions. So there was a question that came out, about a couple questions that I thought might be helpful to answer related to this. One is, if I get a no, would the fund manager or the funds give me feedback? And sometimes what we try to do is we always try to provide some feedback, but I have to say there are some times where it's just like, this just isn't a fit for us. Like, it may be the best thing since sliced cheese, but we don't invest in food and bev, right? So and the reason for that is that it's got its own kind of particular domain experience that we don't have, particularly when those companies get to about $1 million in revenue. There's a whole element around financing and survival that's just different than some of the other consumer brands that we work with. Somebody also asked a question like, if I went to PS at Portland Seed Fund and they said no, should I go back? And I would say, I don't know exactly how Portland Seed Fund handles that, but um, there are times where we say no and it's a no. Like, and if people say, well, I need to know today if it's a yes or no, then, I would say then it's a no. But there are also times where, in startup time, 3 months is like a lifetime, right? So tons can change. We had one company that we said no to and said, come back in 90 days. And they came back and they had kind of pivoted, and there were a couple of people that were there that were then gone from the company. And we were like, okay, let's do this investment. We think it's valid for us. So again, but this goes to the sales process. So I get these kind of sometimes really vague inbound emails, but if I get, a thoughtful email from an Oregon entrepreneur or a Pacific Northwest entrepreneur, I'm more likely to be able to respond. I used to respond to every email I got, even if it was spam, and it becomes very, very difficult from an information management standpoint to manage all the inbound. So if at first, like somebody asked me a question last week, and I actually had COVID last week, and I missed the email, and they came back 2 days later, and I was like, oh, I'm so glad they did, because I did actually miss this, and that would never be my intention, to not respond to a valid inbound, but sometimes it does happen.
Oh, thank you, Julie. Let's see, I'm trying to think if there are any other questions that are kind of in the same vein. No, I'm gonna switch gears, look at my list here, and we had a question that says, what is the best way to cover legal costs? Do you know any resources? And we did touch a little bit on, how important it is to have, an advisory team of lawyers and accountants and other folks. So how do companies deal with those expenses?
Yeah. Well, there are legal firms and CPA firms who have startup packages of different kinds. So that is one way to do it. Another way to do it is, and these things would need to be validated, of course, but if you know other entrepreneurs, they may have found ways to solve this that are less expensive. The National Venture Capital Association has a treasury, a treasure trove, a treasure chest of standardized agreements for doing deals that is out there that a lot of people use as the basis. Like most of the documents that we get are based on those with some customizations. And it just turns out that it costs a few $1,000s to get set up in the right way. And again, I would be very cautious about trying to set up a business with no funds available, right? You need to have at least some of your own, a little bit of your own gas to put on your own fire to get it started.
Yeah, it's probably true. That's also where a lot of friends and family money, at least a lot of my clients, they'll start with formation, but then they'll raise a little bit of money from friends and family even before they come to someone like yourself, because that's the fuel they need to get there.
Yeah, and that's, again, that can be very expensive money, both in terms of how much equity you have to give up or ownership you have to give up, and also in terms of friendships and relationships. So, just being very, very mindful of that piece. But yeah, when we see a company, so usually they've had so somebody recently said to me that they called it friends, family, and fools money. because because it's sort of like, oh, let's just try this. And so there are people that have grants or friends, family money just to kind of test the concept. And where we come in is usually the company has built something. They've built something that somebody beyond their friends and family care about, and they've built something that people are willing to pay for. So in that earlier stage, you really are kind of, there's so much that an investor can't know. You're really kind of selling, your trust, and you're having them invest their trust in you through giving you some dollars to get started. And I've done that well, and I've done that really poorly. When I started my first company, I you know, I took some investment from a family member, and it was a very, very difficult and volatile situation. This is many years ago now, but that's a tough one. There's a question that just came up. Is it good? I can't see it exactly.
Let's see, someone did ask just in the chat room, is it a good idea to divulge your personal investment in your company? It's kind of related topic.
Yeah, I would say that yes. I would say, speaking personally, that I as an investor like it when I know that a founder has put some of their own money into it. And honestly, in my case, it almost doesn't matter how much. It's just that it's significant to the person, right? And the other thing that I think a lot of people fight an uphill battle against is, have you done this before? Because anybody who's ever started a business, as much as I learned, as much as I studied, as much as I knew about, it seemed like in my first business, I made every mistake that could possibly be made. It just is like one of those things, like to having to integrate it. And so once you've been down the road once, you kind of know where the potholes are and how to walk around them. And I think that that's a feature too. So as a founder, when we talk about the helpers, it's like having somebody in your court that knows a little bit about the potential common pitfalls that entrepreneurs fall into would be super helpful.
Again, having that network of people that kind of guide you along the way. So maybe that's a good question, is how do you go about finding those people? And you touched a little bit about sometimes you can make a bad choice there, but again, how do you find people? How to bring them on?
I mean, the way that I found them is so when I went to Bend, I moved to Bend to start the fund, and there was a group of people there that wanted to have a year-round fund. And so I just started, I found, 4 or 5 people that were friendly enough to make introductions for me, and I met with everybody I possibly could. I had breakfast, lunch, dinner, coffee, drinks. I think I gained 20 pounds and got about 20 investors to start the fund, right? And so it's really a matter in some ways of numbers and making sure that you have enough self-awareness about what you are trying to do, that you kind of meet the right people. But you have to, make those requests and be out in circulation. And some people are more introverted than others. I happen to be pretty introverted, but I just had a thing that I did, and I had the story of my own career. I had the story of my idea to do this fund, and I had a history of being, trustworthy enough that people were willing to think about writing a check, but we didn't have a website. We were just getting documents. I mean, everything that you all are probably facing was really the startup that was Cascade Angels, which is the first iteration of what is now Cascade Seed Fund, which is a much more traditional venture fund.
Hey, Ernie and Julie, a question came in the chat, and it's related to cap tables and entrepreneurs, selling off such a high percentage of their company that they don't get to realize, the profits or a big win when they sell. So the question is, what percentage of a startup should be anticipated to sell off? In essence, how much of their company should they anticipate selling off in exchange for a certain amount of investment funds?
Yeah, that's okay. So this is the art and science question, right? It's like, do you get a small percentage of a big pie or a big percentage of a small pie? Those kinds of things. But and this is one person's opinion, so take it with a grain of salt. You want to think about so when you're doing your first raise, how much your company is worth is kind of like, it's around this much, and it's sort of like what the market will bear, but usually it's, in Oregon, it's usually sub $5 million. Every time you raise, you want to think about, and these are just baselines to kind of measure against, but you want to think about doubling the value of the company. So if you raised at 3 million, then the next time maybe 6, the next time maybe 12, and unless the market will bear more, of course. That way you don't necessarily dilute yourself, but and Ernie, you may have a more refined view on this than I do, but that's sort of how I think of stair stepping it, so that you just kind of have a sense for what kind of ballpark you may be in. And another way to look at that is what other kinds of activity are there in the entrepreneurial committee and community in terms of valuations and the type of company that you have.
And I could throw out that, at least sort of reference to the traditional model, at least the way I've learned it over the years, is that in every round that you raise money, you're likely to give away between, and there's sort of just a reasonable standard, 25 to 45% of the company. And of course, you want to stay on the closer to the 25% with each round. And so then it's always a function of the value of the company and how much you're raising. So in other words, if your value is $1 million and you're only going to give away a third, you can't raise very much money. And so again, it's a matter of kind of considering, okay, if I raise a small amount, what can I accomplish to double the value, as you were describing, so that I can then raise more money and give away less of the company because the value's gone up. So there is that sort of planning, and I think that's one thing that a lot of entrepreneurs do with their lawyers and other advisors, is try to sit down and think about those approaches before they get too far and get themselves where they've got an unusual situation where they've sold too much of the company. So anyway,
yeah,
that's
and
just,
we like to see, I mean, yeah, we like to see, people have, again, this is that smaller pie, bigger pie question, but somewhere it's great if you go through 2 or 3 rounds of financing to still have 25, 30% of the company, if you can, is a great thing. The other thing that's funny is, so in the first, say you've done the friends and family and you've got like 7 people on your cap table or whatever, or you've got like 13 people who've all done $5,000 or something like that. When you get into these next levels, those investors don't like to see what we call a cluttered cap table. So it's like, it means like, okay, if we're going to invest, or we're going to have to deal with Uncle Melvin, who doesn't understand and is going to hold up the whole deal because he owns X% of the company, right? So trying to keep your cap table as uncluttered as possible. We have one investment where there are like, I think maybe 70 individuals on the cap table, which is just a kind of a nightmare. But because of the sophistication of the people that are on the cap table, we felt like it was a worthwhile risk to take. And then when that company gets ready for its Series A, what will happen is those Series A investors want usually at least 20% of the company, so they'll have to do some things to actually get those people removed from the cap table by buying them out, or doing something different to consolidate that. So it's just an interesting piece. We over the years, like in the beginning, that didn't emphasize itself so much, but as we see the companies get to year 4, year 6, and into that sort of 5 to 8 year period where the companies actually start to become valuable, it becomes much more of an issue, because a company trying to exit that has complications in how it was capitalized is harder to sell.
it certainly makes transactions more complicated, and even just, I think a lot of entrepreneurs don't realize the logistics of managing all of those people, giving them notice and getting them to sign things can be, from an investor's perspective, I think, you touched on this, difficult. It just means you've got more work to do.
Yeah, and a lot of investors are really mobile. So like we've had things happen where, like we co-invested with somebody, and it's like, well, that partner's in the in the Sea of Japan on a ship to shore connection and has to sign this on a Saturday kind of thing, and so it's that question of really, you know, it's it's a question of how well you can manage, right? And a lot of times growing a company has to do more with like sort of spray and pray, like let's just see what happens. But those kind of fundamental disciplines around running a business, which are not the glamorous part of this work, right? Like 80% of what we do as fund managers is administrative, right? It's compliance, it's taxes, it's reporting, it's contracts. The 20% is what you see when, we're out like tomorrow at the OEN Awards event, having a really great time, right? The rest of it is really quite a grind to make it work. And it's the same with any business, I think.
So how do entrepreneurs find people like yourself? You have a website, but how are there resources for them to, figure out who are the funds they should be talking to and who's active and not active? And
Laura, can you do that? You can do that, right? You do that.
Yeah, yeah. So thanks for mentioning that, Julie. Yeah, so finding individuals like me, and I can share who are the key investors or key funds in the region. You can even Google and find that information as well. And as Julie said, with her particular fund, I mean, she has a web page and you can find all sorts of information about the fund managers and the types of companies they invest in and at what stage. And so there are obviously going to the computer and doing those searches and finding out, but also people such as myself, and there's a venture catalyst in the Salem area that covers 3 counties as well as one in Bend that covers Central Oregon. So we all know these fund managers. And in addition to what's on the website, I think we can add a little color or insights on the people as well and size of investments. But a lot of that information is available if you just go look for it.
Yeah, that's really well said. And there are those resources right across the state, and there are various accelerators, Oregon Bioscience, Virtue Lab, Accelerate. There are lots of those types of. Built Oregon is another one for makers, where you can get plugged in, and we all know each other. That's the other thing, because it's not this huge. It's not like thousands of people. It's like less than 100, right?
So maybe back to the referrals thing, and like you were talking about before, I mean, part of every entrepreneur in Oregon and Washington is to really network. I mean, you just building a network of people who will continue to connect you to the next person.
Yes, exactly right. And the other thing I would say about that, Ernie, it's a great point, is, I was like, somebody said, well, Julie, that's kind of dangerous to do an ask you anything question, because somebody might come up with something personal. I'm like, well, yeah, that would be embarrassing. But I would say on a personal basis, I think it's really important for people who are trying to do this kind of work to have what we call a kitchen cabinet, right? So you've got 2 or 3 people that you can go to no matter what. Like I have friends that are, have expertise in different areas. I have one friend that I call if I'm having a bad day, because I know she'll always say something nice to me. Those kinds of things. Like you need to have that support network to try and do this kind of thing, because there's a reason they say leadership's a lonely place. And when you decide to be an entrepreneur, there's sort of a solo thing, because there's lots of people that will complain about their work, about their life or whatever, but there's very few that sort of strike out and say, I'm going to try and do this with my own authorship, where the only thing between me and success or failure is me, not somebody else, right? So it takes some guts, but it also takes, I think, a support system and as much self-awareness as possible, because in the end, it's those things that get us in as much trouble as, maybe not understanding how to read a profit and loss statement.
Right. Well, let's shift gears a little bit again and talk
Look like
about,
somebody, did Joy have a question? No, okay. Oh,
I was
okay.
thinking that we shift gears into kind of different funding models. So
Yeah.
in Cascade, do you guys generally always do preferred stock financings, or do you consider other approaches?
So for those of you that are, I don't really know everybody's experience, so I'll just start very basic, but um, the the simplest way that we would do an investment would be through what's called a safe note, which is basically a simple document that allows us to invest in the company. There's usually some interest rate related to it, and then at a certain point, that when the company is actually ready to convert to a preferred equity round, which is when it's often when it's a little more mature, those shares convert into preferred equity. We like preferred equity, but honestly, at the stage that we are, we like safe notes. Now, safe notes were kind of frowned upon for a long time because they were very lightweight and they were very entrepreneur friendly, but they, as documents, they have matured enough so that we feel pretty comfortable utilizing those for, say, the first couple of years of an investment. And doing a preferred round requires more expense for the company to get that set up. The paperwork is more comprehensive. How you do the valuation is more complicated. It's just more. It's just another layer to have that put in place. So it can be easier on the entrepreneur in those early stages to do a note than it is to do equity.
I would have to say, over the years, Portland had been a convertible promissory note town, but I do sense it's really shifted these days, and most of my clients use the safe note. And so if anyone on this call is not familiar with safe notes, that's something you should read up upon. And I think it was Y Combinator originally created those.
Yes.
And so you can still find it on their website. So if anyone's looking for them. And then we did get a question about what is a preferred stock financing. So maybe let's just touch on that just for a second, just to kind of bring everyone up to speed.
Yeah. Well, I think the reason that they call it stock because it was originally about actual stock, right? About cows and things, right? But basically, preferred stock means, so with a safe, it's essentially it kind of confuses it, but it's essentially a loan. It's basically us saying, for a period of 2 or 3 years, we'll invest this money, and you set a valuation cap, and then you usually earn somewhere between 5 and 20% on that money over the course of those years. With preferred equity, basically the company is what's called priced. So it means that it has a valuation. It's been valued at a certain amount. And so when you buy preferred stock, you're actually buying ownership in the company. So, and it gives you in the stack of investment, it gives you a higher priority than common stock, which is often what is used in employee stock option programs. So you think of it where it gives some protection also if the company goes into debt as well. So it's just a different, you're basically buying a piece of the company versus loaning the money for a couple of years, hoping that the company becomes more valuable, is a simple way to say it.
So when you see companies that come to you, what if they've used other means of raising capital, like SBA loans or grants? And how does that affect your analysis of the company? Is it
So
a negative or a positive?
yeah, it depends. So like with grants and things like that, like a lot of companies that are in healthcare and some more science-based companies will have grants, like research and development grants from the Bill and Melinda Gates Foundation or from National Institutes of Health or whatever. And we like those in a way because they are non-dilutive. So they provide the company with money to develop their products and services without having to take on an investor. One of the challenges with companies like that sometimes is that they can get addicted to grants, and they can sort of culturally, and this is not 100% of the time, but they can culturally have a different ethos in terms of how fast they move, because it's a different kind of money with a different risk profile. With SBA or any related debt, we just like to look at what the debt position is on the company and if it makes sense to us. Like if a company has, a few $100,000 worth of debt and the founder's not paying themselves and, they've been late on paying their employees, that's a risk profile that would make it more difficult. So it's really, again, going back to those fundamentals in and of itself. Expansion through an SBA loan or some other, kind of low interest, entrepreneur friendly debt is not a bad idea in and of its essence. I think importantly, again, back upstream, it's what is your plan around raising money and how does taking on this debt accelerate it so that eventually the company will be stronger, right? So people will come and say, well, we want to raise money, and we're like, how much? Well, $2 million. What for? Well, we don't really have that thought through. We just know we need money. So raising to a plan is always going to, I think, keep you in a better position because you're not just taking in this huge lump sum of money and then throwing at things trying to make it work. But that's the planner speaking, right? Like I'm the planner, so.
It feels like that is an important exercise of all entrepreneurs, is really to think about the milestones or what sort of steps along the way that they need to achieve in order to keep increasing the value. And sometimes that's the best way to drive and how much money you need to raise.
Yes, exactly right. And investors really like that. Like if you say, I'm going to raise this money, it's going to get us to X amount in revenue. And you come back and you say, well, we didn't quite hit this, but this is what we learned, and here's what we're going to do for our next milestone. So if they have a sense that you're actually managing to a timeline and managing to targets, even if those change and you communicate, we've had companies where it's like, well, we didn't meet our sales target, but actually we did some other things to save some money. So our burn rate is less, our monthly burn rate is less. And so we've got a year, 18-month horizon. And that's another thing, is to make sure that when you're raising money, you raise money, especially in today's environment, that will take you out a number of months so that you don't get stuck in 6 months and you don't have any funds to expand. So being thoughtful about the time frame. Also, there's a lot of movement towards companies trying to be break even as quickly as possible, because then you can control your destiny, right? So you're not running out of money and needing to necessarily go raise money in some sort of a fire sale because you've actually reached a certain level of profitability, and that's later down the line. But early on, that can be a tough row.
It's kind of related to we just got a question in the chat room that asks about, should the company already have some revenue? I think we touched on that a little bit earlier, but it does seem to me that revenue is an important aspect of your analysis, but other investors as well. And when should that start occurring?
Well, I think the answer to that is sometimes I would say as soon as possible. But it's more likely that if you can show, again, I think I mentioned this earlier, if you can show that you've built something that people beyond your friends and family care about and that they're paying for it, is really helpful. We do have some companies, it's very rare for us to invest in pre-revenue companies. There have been a couple that were able to effectively show us metrics that indicated momentum. But those are pretty few and far between for us, because we like to see that exchange of dollars as a as a point as a proof point that there's some momentum there.
So how important is the team itself when you're analyzing a startup?
Yeah, these are such great questions. And the sequencing of your delivery is fabulous. So I would say at this point, like when we invest, there's so little we can know. Like there's a lot of things that we can't know about a company because they don't exist yet. We can know about the team, right? So the team becomes very important. Like, do we believe that this team can execute on what's being promised? And the way that we evaluate that is by having enough conversations with the founder that we kind of have a sense for who the person is. We look at we look at their employment history. We talk to people that know them. We talk to people that might have been customers or are customers. So that's something we try to validate pretty thoroughly, because if somebody has reputational risks or a history of not following through or not being able to convert their ideas into reality, it's pretty important for us to know that up front.
Very, very important. Well, we're actually going to be bumping up against 1 o'clock here in a few more minutes. So maybe what I want to do in our last few minutes, if there are any just sort of questions from the audience to kind of wrap up a few points, let's do that. Or Laura, did you want to jump in?
Yeah, because I know I got a list of 25 questions from everybody, and I know we didn't have enough time to get all of those addressed. So what I'd like to suggest is, one, if you feel you had a question that wasn't addressed today, please send me an email. I'll see what I can do to address it. And if I can't, I'll send it over to Julie. And Julie, if you'd be so kind to, respond back to me. I'll try to consolidate them all so you're not peppered with emails. But let me offer that, number one. And number two, a couple of people have asked about resources. And so what I'll do after this as well is send you a link. So on the TIE Oregon website, I actually have a resource guide for entrepreneurs. And it's categorized by like incubators or accelerators and equity funds. And then also great organizations that provide loans. And I think for some of you entrepreneurs out there, that might be the best next step forward. So let me provide that link, because I think that, and these are Oregon based. Someone asked me about Oregon, Washington, but they are Oregon based. But it gives you a broad sense. There are incredible resources out there to help entrepreneurs, but many times you just don't know about it. So refer to that resource guide. Always, come back to me. In many cases, I can provide introductions to many of those resources, and I'm happy to do that. And were you going to say something, Julie?
I was just going to say thank you for inviting me. And if you have feedback about things that worked well, or things that, I'm on my phone here, or things that could be changed, I really welcome that, and appreciate the great questions. Thank you, Ernie, for all your volunteering, for your great questions. And Laura, you're just such an incredible resource. So I appreciate the opportunity to be here today. And thanks to all of you, and good luck.
Thanks, Julie. This was just fantastic. Really appreciate it.